Hey, I'm Chris Perras, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas, and this is Christmas weekend here. So I'm going to keep this episode short and focus on 4 charts, tables, and data sets. Before I do, make sure to click on the subscribe button and the notification bell so our team can notify you when we upload our latest content. On December 16th, we released a podcast warning that our call for a fourth quarter rally should be running into resistance in both price and time due to 4 things. 1, more Federal Reserve hawkish talk would be forthcoming. 2, chart technicals. 3, stock buybacks slowing into year-end. And 4, year-end tax loss selling by individuals. Well, someone out there might have seen the same things we did. We sold off hard last week. Here's an updated chart of the S&P 500 through December 15th. Okay, no, it's still not a pretty picture. The S&P 500 remains in a downtrend that was established early in 2022 when our Federal Reserve went full inflation fight. What's impressive to me is to see the magnitude and timing of the rallies and sell-offs since the late second quarter summer low. You want to talk about looking rigged? Someone is playing this station to station. A 41-day rally from the June low to the mid-August high. A 41-day trading pullback into the October 13th low. Then a 41-day trading rally into the short-term December 13th top. That doesn't look like a coincidence. That is a big or multiple big players trading. And to make it even crazier, the rally in the cash S&P 500 from June 17th through August 16th was 688.4097 cash S&P 500 points. The rally from October 13th through December 13th, including the crazy futures trading pre-open on December 13th around the CPI number, which took futures to 4180. What was that? That was 688.4204 points. The difference of barely 0.01 points. Folks, that's computers and only computers. So the Fed is still on inflation fighting warpath, even though the real-time data has the leading inflation data series dropping like a stone. How do we know this? First, as we previously discussed, the Fed raising short-term interest rates is quickly slowing economic growth and hurting the PE of the entire stock market. Here's the chart of the 2-year real interest rates, also known as 2-year tips. It's easy to see. This trend has been up and to the right since the Fed went full hawk in late first quarter of 2022. The S&P 500 has remained in a downtrend. Investors, when this yield finally peaks, the overall stock market should exhale. So far, that hope has been premature, and the December 14th statement by the ECB made it a little tougher here in the United States. For now, the stock markets remain concerned that the Federal Reserve's actions to fight inflation will push the U.S. economy into a first half 2023 recession, whether the Fed wants to or not. That's what most Treasury bond market yield curves are saying, particularly the ones that have been pretty accurate in forecasting future economic activity. Here's a chart of the 10-year yield minus the 2-year yield. It's called the 10s minus 2s curve. It's as inverted as it's been since the early 1980s when the economy sustained a nasty downturn. Hope, which isn't an investment strategy, is that the Fed sees a moderation in whatever inflation signs they're looking at over the next 6 to 8 weeks and slows down its rhetoric. About the only good news in this chart is that it's about as bad as it gets, but it does say caution is warranted on fundamentals for companies and the economy in the first half of 2023. But since it's the holidays, I don't want to leave this podcast on a totally down seasonal note. So I give you a chart of inflation. It's a subset of the CPI that those watching real-time data wish the Federal Reserve would look at. But so far, no dice. Remember, freight rates are down. Energy prices, they're down. Commodity prices, they're down too. Car prices, down. Food prices are headed down. In fact, the entire consumer's portion of the CPI basket, ex-shelter, which lags by up to 3/4, is now deflationary, not inflationary. Here's a chart since COVID hit over 2 years ago of the 3-month annualized CPI basket, ex-shelter, provided by Steno Research. Below 0 on the graph is negative. That's deflation. Above the 0 line is inflationary. We're now negative. For what it's worth, the 10-year average for this data is 2.2%. That's pretty much aligned with the Fed's goal of inflation of about 2%. Investors, remember, unfortunately, the Fed looks at slow and lagging data on the way up and on the way down. They're waiting for the job market to roll over and cool and signs of wage inflation to go lower. This should happen in the first half of 2023 with the economy slowing rapidly. It's just a matter of time. Take a look at this chart showing the lag between goods and service inflation. The lag is usually measured in 3 to 6 months, which would put the rollover in service inflation in mid to late first quarter of next year. Believe it or not, most companies hate firing employees. Why? Because hiring and firing employees is a long-term investment decision for most companies, and most know that hiring, firing, and then rehiring employees is very costly. Hiring full-time employees is supposed to be a long-term fixed investment, one measured in years or decades if done well. Laying off employees comes with reputational business costs, their training costs, and their administrative costs, and few management teams want to make these hard choices unless they're forced to. Investors, with the near historic volatility of the combined stock and bond markets in 2022, our investment team recommends that you get on the phone, give our Oak Harvest concierge team a call, and ask to speak to one of our advisors and planners. Set up a meeting and sit down with our team. Let us help you crunch the numbers and let us walk you through your retirement plan. Let us stress test your situation so you don't have to stress as much about your retirement years. Give us a call at 877-896-0040 and give our team a chance to help you with your investment allocation and have our financial planning team model your cash needs and maybe a few of your greeds too, into and through your retirement years. I'm Chris Perras, CIO at Oak Harvest, and from our growing team here in Houston, have a great holiday season.